So let me pick screen two. I will start off and say, wait a minute, shared the wrong screen. You guys don't see my screen there, do you? Let me do this. Let me move it to here.
Right now, you have Zoom on there as the screen share. There it is.
All
Is
right.
that tax planning for real estate agents?
Yes. Now this first page, obviously you guys were not getting credit today, but I do teach this as a 3-hour CE class. So I will move kind of quickly because obviously we don't have 3 hours. Um, I do want to say if you need to leave the meeting, I know Ming is recording the meeting, so you could go back and watch. But I'm going to try to stay on task and move through quickly, and but yet cover and give you enough ideas to where you can look further into it on your own or with your CPA. One thing I do want to correct though, because I just don't want somebody reaching out asking later. It is North Carolina that we're licensed, not South Carolina. I've had people ask me about South Carolina, and I'm like, we're not getting licensed in any other states. I'm sorry. There's other brokerages over there. You just have to find somebody because it's 3 states is enough to keep up with education on. So let's move right along. So at the top, you see this is what you feel like when you've had a great year, you're getting your award, you're real happy about all the money you made. And then the bottom, you see, well, uh, now you're going to have to pay tax on all that. And that's not the fun part. Um, so some common real estate expenses that you guys would know of. Um, Here's a list. So your advertising cost, you know all of those things you can deduct. The client gift or gift cards, it is limited to the $25 per client or per each time you do that. But if it's a branded gift, there's no limit. So for instance, we started giving Cutco knives. Okay, well, those knives are over $100 a piece, but they're 100% deductible because it has our logo on it. And it's something they're going to use in most cases, unless they lose it, they'll use that knife the rest of their life. I mean, it is not going away. It's not like a gift card where they go out and eat once and then it's used up and it's gone. They use it over and over and over. So that's why we like to use those. Now, there's other things it could be a cutting board, it could be anything branded, and you want to get something that they use because the whole point is for them to be reminded of you, correct? And I want to say this if anyone, as I'm going, if you have a question, unmute yourself and ask because otherwise, and if it's a question that could wait to the end, write it down and then I'll give everybody a chance at the end as well. But your signs, lock boxes, any printed materials you do are tax deductible. Professional fees like team building outings, MLS dues, obviously, licensing fees, uh, anything educational. If you can say that anything was educational, your mileage when you drive to a CE class, that's deductible. Um, it's like I tell people that come to, when I do this as a CE class, I said, if you would have paid for this class, it would be deductible, but you didn't. It was free, so there's no deduction. But you can be creative there with educational. We're doing a cruise next month, and I have 4 of us going on the cruise, our own staff. My wife and I and our kids work for us. 2 out of our 4 are going with us. Well, I'm going to do some educational things with them and some team building things on the cruise to make it tax deductible. But I have to document it, and we'll talk more about that later. And then any office equipment supplies, you say, well, I work at home. I don't use a lot of office supplies. Well, ink or toner for your printer, I'm sure you use that, right? So anything you can come up with, even stuff you order on Amazon for your business, computers is a big one. Our youngest daughter is in college and she needed a computer for college. Well, she also a laptop, but she also works for us 9 hours a week and does our social media and stuff because a 19-year-old's way better at that than I am. So she needed a computer for work and school. So I bought her a laptop, um, and that was a tax write-off because it's for work. Now, does she get to use it for school? Yeah, but still, you got to be creative and look at, well, how could I, as long as I can justify that this is being used for work, then it's a write-off. So some things we're going to cover today: your elite status versus the majority, vehicles, maximizing deductions, medical, the home office, the number one cause of overpayment, meals, and then we'll have the questions and answers at the end. All right, so all of us as agents, we are self-employed. There was a time that I was an agent. I was self-employed as an agent, but I was also a school teacher and coach in the public school system. So I did get a W-2, but I also got a 1099. Um, but the majority of us, as a self-employed person, we are way different than the majority. And let me give you an example of that. Like I can look back I like log into my Social Security account and I look at how much tax I paid when I was a school teacher making 82,000 a year and like 12,000 a year coaching. Well, I paid a whole lot more tax then on that money I was making because you get a W-2. They take those taxes out. There's nothing you can do about it. You can write certain things off even as a W-2 employee, but there's very limited things you can write off. Well, now I make more than I made then, and I pay way less tax than I paid when I was making less money. And just like you guys that joined Maximum One, you realize it's more about how much you keep more so than even how much you make. Like if you've been at a company where you were paying 20 to 30% of your commissions to the brokerage, and then you move to Maximum One, well, now you can actually work less and make more money than you were making before. I don't have to explain that to you. Everybody on here is with Maximum One, so you know that. Um, so the next best thing you can do is you can keep more of that money you're making. So a lot of people say, well, what if I have too many deductions? Well, if you're in business, you can't have too many deductions. There's no such thing. But the key is documenting. So, and I don't know if I skipped a slide. No, I didn't. All right. So a question I get a lot is, should I have an LLC? And I see some people taking pictures. I will send these slides. I will get the link and put it in the chat before we're done. Just somebody remind me. That way you can go back and look at these slides. So I get asked a lot, well, should I form an LLC or not? Well, the answer is it depends. It depends on how much money you're making. Like I didn't have an LLC until I left teaching and went in full time into the business. But would it have benefited me? It probably would on some years, and in some years it really wouldn't. It really depends on how much money you're making. And then also, like I have multiple LLCs, but I only have one that is an S corporation. And with an S corporation, the reason it works good for me and the situation I'm in is with an S corporation, you're required to pay yourself a reasonable salary. And I started noticing there was a time when my wife and I made 50,000 a year. She made 50,000 a year in salary, and we got taxed on all of that, like Medicare, FICA, obviously state and federal, plus employment tax. And now there's the unemployment tax. There's all these different taxes that come out of that salary. And the lady that had been my bookkeeper, she ended up moving to Florida and no longer works for us. So I took the books over. So then I started looking at what taxes were coming out of that salary. Well, after the mad rush of 2021 and things started slowing down, I decided, you know what? I'm paying myself too much salary because it's getting taxed on all this. So fast forward to today, now I make 22,000 a year salary and my wife makes 22,000 a year salary. That's what gets taxed by all those different entities that pull money out of your check. Um, Now, as an S corporation, if I need money, I can pull what's called a distribution. If I pull a distribution, the only tax that comes out of a distribution is state and federal. You're not paying Social Security, Medicare, all these other things that come out of a distribution. So even though my salary combined, we make 44,000 a year. And you're like, well, how can you live on that? Well, I mean, I could, but I choose not to. But I just pull money as I need it. If a credit card bill is a little higher and our salary don't cover it 1 month, then I pull enough from the business to cover that. And I only have to pay state and federal tax on that money that I pull. Um, so you have to figure out, what works best for you based on your level of income from your business. So there's no such thing as too many deductions when you're in business. Um, but the key to it is documenting. You want to take every possible deduction that you can. I have a CPA that handles our stuff, but even though they do a great job, I still keep a list and I still track every deduction I can think of because I'm not their only client. I could see something getting missed. So you want to make sure that you're tracking your own deductions and keeping up with that. Um, and then looking in the middle of the page here, net operating loss rules. Now this is where my CPA comes in big time, and I'm going to show you some examples in a little bit, um, like how assets work and how there's rules for using them to depreciate the amount of money you're making on that asset. Pass through loss, if if you track it well, you could actually show there's more expenses than income. And then you show a loss on that K1 that comes from this LLC you have. And then it would lower your tax liability on your personal taxes. Now, I will say the only problem with that, you can only take a loss so many years in a row before they are going to say, okay, there's a problem here. Nobody stays in business that long if you're losing money constantly. So, you got to use some common sense with that. Um, and here's the example I'm going to show. Now, this is actually some of our tax forms from last year. And most of you don't know me. If you did, you'd know I'm an open book. I'll share anything you ask. I don't try to hide anything because I don't have anything to hide. But this is a building we own up in Hiawassee, Georgia. It's a commercial building. We have 5 tenants in it. Um, and I've learned a lot becoming a landlord of a commercial building during the years we've had this. But if you look on this K1 from that company, the company is Matheson Properties LLC, and there's 4 owners. It's my wife and I and my mother and father. So when we get our K1s, there's 4 K1s goes out. So each one of us gets our own. And I don't know how the depreciation stuff all works. That's why I have a CPA that, tax laws change every year. I'm going to go over one example of a change that actually hurt me this year if I would have waited, but I didn't know it was coming. But just like in real estate, our forms change twice a year. You're expected to be the expert on that and to know and help your clients based on the current GAR forms, the current rules that we're following, right? So the tax people do the same. So, and box number 1 up there where it says $2,501, it's a loss because of depreciation of the building. I can't answer if you've got the question, well, I thought real estate goes up in value every year. How's it depreciated? The answer from me is I don't know, but my CPA knows. All I know is there's $10,004 of depreciation last year on that building. Well, $2,501 gets credited to me, and the same amount gets credited to the other three owners. Well, our total net income on the building after everything was paid was $39,888. So that got divided by four. So we each got credited with the $9,972. So the ordinary business loss of $10,004, the depreciation, that comes off of that 39,888. So in the end, even though I had received $9,972 and my wife received that much, because of depreciation, it lowered it to 7471 if you look down at the bottom. So, when you have assets, like I said, I'm not a tax expert. I should have said this in the beginning. I'm not a tax expert, but I have really, since 2 elections ago, I've really spent time working on figuring out what I'm doing wrong. Because if millionaires aren't having to pay tax and they're following the tax law, why am I paying tax? And I don't mind paying my fair share, but once again, if you can follow the tax laws and save money, then you're doing nothing wrong by doing that. So let's move on. Another thing to think of, we grow up, we think, April 15th is tax day. That's when our taxes are due. If you're in business, every day is tax day. I think about tax. I think about it so much that I even think about it for my lawn care people. All right, I have a guy that he just does our front lawn and the lawn around our barndominium. And what I do for him, I have multiple LLCs and I will keep track and I pay him and I keep it under $600 from each company. So I never have to give him a 1099. So he don't have to report it. He gets paid, but I'm paying him from, I have multiple companies. So I just pay him from a different company until I get close to that mark because this is a guy who lives in a trailer on some land out in the middle of nowhere, and well, not really nowhere, but I mean the guy struggles to get by, so I'm trying to help him out too. But I'm always thinking about taxes every time I go out to eat, anytime I'm paying a toll to go through or traveling or something, or a parking permit, any of those things. But the thing I learned is when you do have an LLC and you are in business, your taxes are actually due March 15th. So it is a month earlier than everybody else. Um, Auto deduction. And I know I'm moving fast. I'm just hitting the high points of all this because the goal is it's gonna spark some ideas in your mind and you'll go back and think deeper into each of these. So moving to the auto deduction. My previous CPA always said, just do mileage. It's a lot cleaner. There's no red flags. Well, there's no red flags on either side. The problem was it was way less work on him and his people to just plug in the mileage as a deduction rather than to keep track of all the things that go into the actual expenses and depreciation of cars. Now, again, you got to decide what's best for you. I can tell you the actual cost, you're going to have a way larger write-off than you will with doing mileage. But it depends. There was a couple of years back in 2015, I leased one of those Nissan Leaf electric cars back in like 10 years ago. Well, I was working for the school system at the time. I got paid mileage for the job I had because I traveled to like 14 schools throughout the week. So it made sense for me to do mileage because I was leasing a car that didn't use gas and I was getting paid mileage through the school. So it made more sense to collect the mileage money on the car. I actually made money leasing this car. It was kind of crazy. Um, so it really just depends on what kind of car you drive and the cost of driving it. And, how much do you drive? These are all questions that you have to ask yourself. Like for me personally, I work from home probably 90 to 95% of the time, unless I'm going somewhere to teach or going to an event. If I have a reason to go to an office, I go in. So I don't drive near as much as I used to drive. So I'm never going to have near as much mileage as I would normally have. So that's not a good write-off for me. The actual expenses is a better write-off for me. Um, there's a thing called bonus depreciation. Now, this is where I messed up. Um, last year, I felt like, okay, this tax laws changed all the time, right? And one of the things that happened was the bonus depreciation. At one time, it was 80%, and then it dropped to 60. Last year, it was at 40. And based on what I knew back in 2024, it was supposed to drop to 20% in 2025. Well, I didn't know in January they were going to change that and bump it back to 100%. So December 10th, I bought a Tahoe thinking, well, I need to at least, to save me 20% on that bonus depreciation if I go ahead and buy it now. But I didn't know they were going to change the law on that. And it did go to, if you buy a car this year, you get 100% bonus depreciation. Don't ask me how to calculate it. I don't do it. The CPA does it. Um, but that is something you're better off buying a car this year than you were last year, as far as if you're doing it for a tax write-off. Um, and then they do a breakdown like the way we did ours. Since I bought it so late in the year, I think it ended up being like $1,500 and something dollars was the only write-off I got last year. But now this year, I'm going to get a way larger write-off for that Tahoe we bought in 2024 because they'll depreciate it over a few years and not take the lump sum. It's actually over 6,000 pounds. We could have taken the full depreciation, but I'm letting the CPA make that decision because she knows what we need to do better than I on when it comes to that. Um, and this is just an example. I'm not going to spend a lot of time going over it, but you can kind of see it when you get the slides. You can look at the breakdown even better. Um, this depreciate. I mean, the higher price car you buy, the better this write-off is. But you don't want to spend all your money on a car. So it depends on what your needs are. Now, here's just a kind of a breakdown to point out between mileage and actual expense. When you take mileage, now it is 70 cents a mile, which sounds great this year because in 2021 it was 56. 2022, it started off 58 and a half, and then middle of the year it went to 62 and a half cents a mile because gas prices, I guess, shot up in 2022. But the thing you have to consider is when you take the mileage, it includes all the things that's listed in the actual expense, your gas, your oil changes, and any other fluids, your uh, any repairs you may have. Tires, we all know tires are outrageous right now. Um, your car insurance. So the 70 cents is supposed to cover all of those things, and it doesn't. Um, so if you look over on actual expense method, gas prices, I know I'm deducting it. I also know as long as it's under $75, I don't have to keep the receipt for gas. Now, if you're filling up and it's costing you 75 or more dollars to fill your tank, then you do need to keep a receipt for that. Um, I always make sure I don't go to that point. And luckily, gas has been at a price that I've not even come that close. But oil changes are very expensive nowadays. And it really depends on what you drive. You drive a Land Rover, I promise you're paying a lot for oil changes. I changed my own one time, and when you take 10 bolts off to take a skid plate down that's very heavy, I said, I ain't doing that again. So I started paying to have that oil changed. Um, repairs, if you have a foreign car that they're expensive repairs, that's a great write-off. Tires, insurance. I don't know about you guys. I've been very happy with State Farm, but my car insurance seems to go up it don't usually make it 6 months. It's almost every quarter it goes up, it seems like. But like car washes, that's That's one that I don't ever think about. My cars stay cleaner than they ever have because I got one of those memberships that's tax deductible, and I can go through that car wash every day if I want, and it's paid for and it comes off. If you go to the airport just to pick somebody up, guess what? You can be there 10 minutes and it's $10. It's $10 an hour down there. So, you know, being able to write those things off is very beneficial. What I like to do too is just find as many things that I'm already paying for and figure out a way to make it a tax write-off. Um, here's another breakdown. If you drive 10,000 business miles, well, that's a $7,000 deduction. But on the actual expense method, 11,200 plus insurance, plus gas, plus all these other things, and the bonus depreciation of 8,000, excuse me, you've already surpassed the 7,000 you would have got on driving for 10,000 miles. Um, and then, like I said, if you go down, single event vehicle expenses less than $75, you don't need a receipt. Um, so just stop the pump at $74. But it is good to keep receipts for everything because it's like one of those things. Like I've got receipts, and typically I'll go back 7 years, and after the 7 years, then I'll throw that file away. Um, Bottom line, credit card statements are not considered a receipt. Now, I don't know how many of you knew that. I didn't know that for a long time. I always thought, well, it's on my credit card and you can see what it was for, but the IRS does not count that as receipts. Now, there's some things that are, if you've got an office and you've got a credit card that you run that office on where you pay the power from that, the internet from that every month, well, it is tracked and they know that those are business expenses. So you don't have to keep receipts for power bills and that internet, that kind of stuff. Now, here's another thing I didn't know. You can deduct up to 4 cars. So you may, if you're doing actual expense, you can deduct up to 4 different cars if you have that many. So let's say you don't, if you use one car 80% of the time for business and 20% of the time for personal, and then you have another car you use 60% of the time for business, 40% for personal. Well, then you've got 60% and 80%, you put them together, that's more than 100% write-off between the 2 cars. The good thing that my CPA always asks me when we're doing this, do you have other cars to drive as personal? And it just so happens I have 4 cars, but I only write off 2 of them. So it is easy for me to say, well, yeah, I do use that car 100% for business because I have these other cars I can drive if I need to do something for personal. So documentation is the key, and being able to, I just always ask myself, if I was standing in front of a judge, and it's never going to come to that, but I just still ask myself, if I stood in front of a judge, how could I explain this so that I would be justified in my decision and how I deducted? All right, making your trips tax deductible. So I can't remember the last time I went on a trip that wasn't a business trip. It don't matter if it was the beach or where I went. It was in some way, some form. It was a business trip. It was a write-off. But you have to document it. And when you do these trips, the best documentation that I have found is really just like we use our Google Calendar, and we put things on there, and you can put the explanation of what the meeting was on that date. And if that date was during the time you traveled, that's your documentation. Now what you want to do is be able to wrap the business travel, wrapping a weekend. So you want to keep track of things when you do things. It's all about the number of business days compared to the total days of your trip. So if you work on a Friday and a Monday, then the whole weekend counts as business travel. So, but if you work on Friday And then the next day that you document that you works on Tuesday, then the weekend's not. So to wrap a weekend, you've got to make sure that you document something you did for work on that Friday and something you did that Monday. And that way the whole weekend becomes tax deductible as business travel. So here's some examples. So like day one, Thursday is your travel day. So you're traveling somewhere. Well, you work on that Friday. You went to a broker's meeting. You talked about real estate agents about relocating. I don't know about you guys. Even when I go on vacation, I like to go to open houses at other places that, I may or may not be interested in buying something. I just like to go sometimes. Um, but you need to document that you went and that you were considering, like I've looked at buildings, commercial buildings, took pictures, keep them on my phone. If I ever need them, I can say, yeah, here's a picture. Here was the number. This is showing it's for lease. We were considering, we're licensed in Florida. So yeah, I never know. What if I decide to open down there? Well, I've looked at this space while I was down there. But then say on day three, on Saturday, you went to Universal Studios. That was a personal day. Sunday was a beach day. But Monday, you went and looked at office spaces. So that Friday and Monday you were working. Well, even though you went to Universal and you went to the beach, it's a wrap and it's considered part of the business trip because you worked on Friday and Monday. Um, so that's kind of an example. Let me see, travel days. Now, where it says travel days don't count in calculation, well, if you're doing mileage, it counts. If you're paying for gas, those receipts, even though you're traveling and your meals, you still can deduct those because you're going. You had to get there, right? If you flew there, well, the flight was tax deductible. All right, here's another one. This is a big one. Now, I personally can't take advantage of this one because we are an S corporation. S corporations cannot do this, but it does work. If you're an individual and you get your 1099 to you, if you have an LLC, or if you're a C corporation. Um, and this is something that I can't go deep in because, like I said, I don't do this, but I know it is out there that you can. And probably the simplest way to put it, let's say you are an agent, well, you guys are agents, and let's say you wanted to hire your spouse to help you with your business. Now they probably have another job, but still there's things your spouse could do to help you, right? Well, you don't pay your spouse a salary. You pay your spouse by covering their medical expenses. So that way, when you pay their monthly like premiums, that's 100% deductible. When you pay their copays for them, it's 100% deductible. If you pay for their prescriptions, 100% deductible. Now, what happens when your spouse, they take out this insurance policy? Well, they're going to cover usually their spouse and their kids. So that way you're covered too because of your spouse's insurance. It covers you. They're the policy holder and you're on their policy. So it's a great way where you can write off 100% of all of their medical needs, dental needs, vision, any of those things would be 100% tax deductible. Now, like when I was in the school system, we would have what was called a cafeteria plan. There was different names for it, but you could take so much out of your pay and it would go into a health uh, savings account or a health reimbursement account. There's different accounts. So that when you did go and you needed to either buy medicine or pay a copay on something, you could access that money to do that with. That's sort of what you're doing with this, but the money's coming straight from the business. So it's being paid with pre-tax dollars. So you're able to write it off of your business. With an S corporation, the way we're set up, the business pays our monthly premiums for us. So it's just different. And you just have to figure out what works best for you to know which route to go on that. And this is just some more information on it. I probably talked and covered some of it, but if you, and it's kind of blurry on my end here, but it lists all the different like examples of things that you could deduct if you're using this 105 medical reimbursement plan. If you decided to go this route, I would encourage you to talk to your CPA about it. If they don't know about it, you might want to change CPAs because it's something, it's not like a new thing. It's been around for a long time. And home office deduction. Now, I will tell you if you're somebody that uses mileage instead of actual costs for your cars, I didn't realize this until a few years ago, but if you want to count the mileage from the time you leave your house, for that to be legal and to be compliant doing it correctly, you need to be taking the home office deduction because your mileage starts when you leave an office. If you don't claim the home office deduction, you should not be counting that mileage. Now, there was probably a lot of years I did that not knowing the rule on it. But now we do have home office, and I'm going to explain that a little more. So I would count that mileage, even though I don't track mileage for the purpose of turning it in for 70 cents a mile. I track it for the percentage of personal versus business. That way, whatever my actual cost is, if I can show the mileage that 95% of my mileage was business, then I get 95% of the actual cost deduction. Now, some things when I used to take the home office deduction, I made some mistakes, and I'm gonna go over something that I never even thought of when I was doing it, but it is 100% legal. But some things to think about that you can deduct is bills for utilities, your homeowner's insurance, if you live in a neighborhood, your association fees, if you pay for security, like your house is monitored, if you have general repairs and maintenance. The thing about all this, like mortgage insurance, property taxes, you can only deduct the percentage of the square footage of your home office that's divided by the total square footage of your house. So I had the house before the one I'm in now, it was like 5,500 square feet. Well, my office space and even the storage area where I stored my signs, it only accounted for like 3.5% of my house. So I was adding up all these items to only get to deduct 3.5% of it, and it really wasn't even worth my time. Something happened, my screen froze.
We see the home office deduction on yours, so that's not a problem.
Yeah, but I'm trying to get to the next slide and it's froze.
Oh, okay. Sound like your software over there, maybe.
It's something, and I'm on the third computer that I've had some issues. Oh man.
Sometimes updates and stuff like that. Just really quick to recap some of the Neil thing, because I do know a little bit of taxes, but not all of it, and why some of the things are done the way it is because it depends on your situation. Everybody write off a little differently. It is
Hmm.
good to get to know your accountant and discuss what write-off is best for you. And if you're motivated to, let's say, buying a home next year, you might want to do your write-off a little differently. And what Neil mentioned earlier about, your income and you can't have losses year after year because that's just not a sustainable um, model for any businesses. So you just have to decide what years that you need to go ahead and do a little less or if not more deduction. And the vehicle thing, like I said, the amortization is basically what government allow you. Basically, it's a freebie, and you get to write all that off. In reference to Neil's building, but when he have fully amortized that commercial property, when he sells it, he's going to claim the profit on that. And what he does, that's another tax strategy you can do when you do sell it, is do what we call 1031 exchange. Basically defer all your income until you're ready to call it quits. So
Yeah.
anyways, that was just on a strategy. So back to you, Nick.
Okay. All right. So here was just an example that I put in. So 25, let's say that the total area of a home is 2,508 square feet. But then you measure your office area that you're using and it comes up to 224 square feet. So that's probably a room plus a storage area. Well, that's 8.93% of the total home. Now, one thing that I didn't know that I could have done, and it does take time on your part, but if you're using this deduction, it's worth your time. When you measure your office area, how do you measure that? You measure it wall to wall, correct? You don't measure inside the walls. You're only the net area, just wall to wall inside that room. Well, I didn't realize that the IRS allows you, you can go and measure the net square footage inside your house, wall to wall in every room to come up, because that way you're comparing apples to apples. Because that 224 is the net square footage of just wall to wall in that room. The 2508 is probably like your total square footage from, the outside of the house when like an appraiser would measure. Well, if you go and you measure inside the walls, like on this particular example, it dropped it to 1,800 square feet of actual living space because you don't live in between the walls in your house. Well, now it bumps it up to 12.44% of a deduction. It's not a lot, but it's something. And if you're taking the time to do it, you just have to measure it the one time. And then every year you would know what that percentage would be. Now, to deduct a home office, what's regular, it's considered 10 hours or more per week. And that is not hard to do. That's like 2 hours a day, 5 days a week. If you're actually full time in real estate, you're going to spend that much time, even if you're opening your mail in there, searching for properties on your computer, attending CE classes online, anything you do. All right, so here I'm going to share an example now. And this is something, everything I've showed you up until this point was stuff I've learned from other people. This was an idea I had that I ran by my CPA, and she thought it was a good idea. So we did it. So we've owned this home from 2018 to this year, 2025. So we met that 2 years of ownership required to avoid paying capital gains when we sell this house. So what I did, I created an LLC with myself and my wife as the sole owners of the LLC. And then we sold our home to that LLC for the market value. And I made it just under, and the market value was probably a little higher than I sold it, but I still kept it just under the $500,000 limit for married couples when I sold it. Now, I have a mortgage. I still have a mortgage on this home that I've had since 2018, and it's at 3.625% interest rate. Well, I said I just formed a new LLC. How much credit does that LLC have? Zero, because it's a new business. There's been no time to create. So what I did owner financing. Well, I still have a mortgage. So how did I do that? Well, I did a wraparound mortgage, and I did it for 1.75% interest with a 20-year amortization schedule. So to avoid paying the intangible tax, we did a short-term loan with a balloon payment at the 36-month mark. Now, a few months later, they changed, IRS changed it. Now it's been extended to short-term loans can go up to 62 months instead of the 36 like what I did, which it still doesn't matter. It just means that at the end of each 36-month term, I have to do another 36-month extension. Now, it may let me go to 62 months when I extend it. I'm hoping that's what happens, because that'd be one less time I have to do the paperwork, but it's okay. Now, the 1.75% interest, you probably think, well, where'd you come up with that number? Well, the way I did it, I looked at how much interest I paid monthly at 3.625 on the actual mortgage that I still owe on the home. And then I took that, I looked to see how I would get that same amount of interest out of the new sales price so that it become a wash where I'm collecting interest on my payment that I'm receiving and I'm turning around paying the same. And it's not down to the penny. I'll just tell you, it's ballpark. Um, but that's why it's the 1.75. It 1.75 on the amount I sold it for is very close to 3.625 on what I actually owe on it. Now, also, since my wife and I were the sellers and were also the sole owners of the LLC that bought it, there was no transfer tax to pay. So I saved thousands of dollars because my attorney, the closing attorney I was using, they taught me this. When I went into this, I knew. Well, I'll just tell you, we sold the whole thing for 1.2 million. I could have sold it for a little more. We have a pool back there. There's a large barn dominium in the back that's, like right now we have some missionaries staying in it that are in from Italy for a while. They're friends of ours. So it's a total living space to itself. Um, but on 1.2 million, I mean, the transfer tax and intangible taxes was going to be a lot. But I knew, well, in the long run, it's going to be worth it. But thankfully, my closing attorney that we've been with for over 8 years now, he looked at what I gave him and he said, well, let's do it this way. And you won't pay either one of those taxes. So it cost me probably $850 total for this sale to go through um, on this house. Ming, did you have a question or anything? I think you unmuted.
It's okay. I had a question. So, this is a good way of what we call creative financing. Basically, Neil bought this house and sold it to the LLC. Now the LLC owns it, and at the same time, he didn't have to pay any capital gains. Now, Neil, do you recommend to do this maybe every 2 year with new properties that you may acquire? Um, and
Yeah.
so this is where the money comes, y'all. Y'all can do this every 2 year with a new property that you acquire.
Mhm.
And the other thing too is that now you may have to pay a higher property taxes because you will lose your homestead exemption on these
Mhm.
properties. So that's the other thing.
Yeah, and that was something I considered because my attorney, he even said, now you know you're going to lose the homestead exemption. And I said, Doug, do you know how much money I'm saving on my homestead exemption? I said, it takes $2,000 off my value of my home. I said, I promise the power bill write-off alone is going to more than cover my homestead exemption because and well, let me say this before I go to the next slide. What Ming said is right. We have been saving our money because we do want to buy another property that we can own as our primary residence for a couple of years and be able to sell it in 2 years without paying capital gains, turn around, buy another one. That is the goal. We probably got like 150 saved up to go towards one, but I'd like to be able to buy one cash and not have it. I don't like payments. I just don't. I mean, the only thing we owe for is our cars. No, not our cars, our house, that mortgage. Um, the other thing I like about this, people have tried to sue us a couple times and we weren't in the wrong. We didn't do anything and we ended up not having to pay. But the cool thing about this is if someone wants to sue me now, well, you're going to get some nice used cars because we take care of our cars because that's the only thing in my name. Go look it up. You're not going to get my house if you sue me. Um, so I like that the because I used to pay just over 150 a month for $1 million umbrella policy. And then I had some close family members that were in some really bad accidents. And don't believe all those commercials about how they're going to get you all this money because the thing I learned, if the person that injures you, if they don't have anything, there's nothing to go after. So I was paying 150 a month just for the possibility of somebody else getting rich one day. It wasn't going to do anything for me because if I don't have anything in my name, they can't sue me anyway. I mean, what are they going to get? like I said, they'll get some nice used cars and then I'll just go buy new cars. I mean, I'm not worried about it. So I like that part of the thing too. I dropped that policy, by the way, 'cause that's saving me 150 a month. Me.
And the thing is, umbrella policy, a lot of people will say, you know, you need to have this umbrella policy just in case somebody sue you. You got over $1 million coverage, yada, yada, yada. But like Neil said, that if you have nothing someone can sue you for, what are they going to go after? I used to have an umbrella policy. I actually removed it because of that reason.
Yeah.
And if you're smart, you will put things in a LLC or in a trust. But once again, speak with a tax accountant or an attorney that knows what difference between trusts and the LLC is, because there's benefits in each one of them. And there's also, it's like DPA program, y'all. Every one of them has its own string. So those strings just depends on what your desirable intentions are. And that's what you need to go with.
Okay.
So, but yeah, I took my umbrella off too, just because of that reason.
Yeah. Yeah. All right. So now looking at this house, these are things that I was paying for all these things. Everything you see on here, we paid for. Well, we're still paying it, but now we're paying it with pre-taxed money from the company, not after I pay myself and pay tax on the money I pay myself and then have to pay for these things. Last Saturday, we got a new roof on the house and the barn, or not the barndominium, that's a metal roof. And it's only 4 years old. But anyway, the garage over here. So I will say State Farm covered the roof on the house. I did have to pay for the roof on the detached garage. That roof wasn't near as old as the other one, and you can kind of tell in the picture it looks way better than the one over there. I went ahead and let the company pay for a new roof for it because I wanted them to match. I changed the color. So, but again, the company paid for the roof on the garage and it paid my deductible on the house because I had a deductible to pay. But we pay for water every month. Well, now the company pays for the water, company pays for the internet. Um, I have lawn service. I actually have two lawn services. I have one that does the front yard, and like I said, that barndominium in the back, it does it. But then I have someone else that does the lawn around the pool and all the shrubs and the beds. Um, and I'm not lazy. I like mowing. I like doing lawn work, but I really can't afford to do it because my lawn's so big. I'd have to go out and buy, $3,500, $4,500 mower to make it make sense to do all that. Um, and I can make more money doing something else, and then the lawn looks fine. But weed control, you notice up in the front it says Home Goods. Well, we've got the company bought us a new sectional for our living room. I was so thankful because we were using one we'd had since like 2006. But see, stuff that I was going to buy anyway is now covered with pre-tax dollars that is getting paid instead of paying myself and getting taxed and then paying um, with my money that way. And down there in the bottom, like the pool supplies. I don't know if you own a pool. Don't ever buy a home that's had a pool for like 10 years because they can tell you I've never had a problem with it. And they probably didn't for 10 years. But that's when the problems start. I've replaced everything above ground on this pool. It's an in-ground pool, so everything above ground's been replaced. Something's been replaced twice. But now I don't feel so bad about it because I do know it's going to need resurfaced. Well, guess what? That 15 to 20,000 that's going to cost, it's going to come out of the business, not out of my pocket. Now it is my business, but still, I just think of the money different when it's pre-tax dollars. Um, so anyway, that's something to think about. That being said, now if I ever went to sell this, which I don't plan to, but I might, you just never know. I would have to do a 1031 exchange, or else I would pay a huge amount of tax on this property. So thankfully, I love where it is, and we'll probably be here. Now, another thing, you say, well, how are you living there if it's an investment property? I pay rent. I pay $1,000 a month to live here in this house. and it covers my water, my power, my internet, everything you see on here for 1,000 a month. You can't beat that. I don't know anybody can find a house to rent like this for 1,000 a month.
Hey, Neil, quick question for you. On the accounting standard, do they allow you to only charge 1,000 or has it go through a reasonable test?
That's There probably is a reasonable test. My accountant knows because here's part of it, and it's different for everybody. But that barn dominium you see in the back, now we did have to move a bunch of stuff to prepare for those missionaries to move in last week. We have been using um, since it's a standalone building, we rent it to our real estate company because we have, and it truly was set up for real estate, like a huge classroom. The conference room was what used to be the bedroom. I mean, everything is set up. Um, our real estate company was paying rent and we were paying rent. So it's not like we're paying 1,000 for the entire space because it's being co-rented by someone else. Now, to be able to do this, something you got to think about, oh, this sounds real good, but where's the money coming from for the company, right? So you have to have, I mean, you do this when you have more money coming in than you have write-offs for. So we had more money coming in from a separate company that's not even our real estate company. And that money's coming in. And I'm like, well, that company has no write-offs. What am I going to do? Oh, well, I'll let that company use their money to buy this house. And then all the stuff that it needs, it'll pay for in write-offs. Um, well, then that's my next thing here. What is needed to make this happen? We got to have a source of income for that LLC, and then rent from yourself to the LLC, and then you determine that amount. Like I said, I picked 1,000. If they come back and say no, you need to pay 1,500. Well, I'll pay 1,500. Um, I mean, it really doesn't matter to me because the money's still coming back to me. But what I like about it is the payment that it's paying me on the value I sold it at. I still just pay the house payment out of my salary. And I've just been putting in savings like, well, I'll say the payment is $5,653, and I don't remember the change, but it's that much a month goes right into my savings account and it's building. Um, and then that income that's coming to me, with the exception of the interest portion, well, it's tax-free income because I sold the house. So, I've got that $500,000 buffer without paying capital gains. So that money coming in every month is non-taxable, except for the interest portion. But then I'm going to write it off because I'm paying interest. But all upkeep is now deductible. Uh, I lowered my taxable income because this really helps drop you in your tax bracket. So I was actually looking this morning at what we've made just so far this year, I would be in the 35% tax bracket for 2025. But because of all the things I write off, I'm at least in the 22%. I don't think I can get down to the 12 because I mean, that's like 48,000 and something a year to get down to the 12% tax. If I can do it, I'm going to, but I just don't know that it's possible. It's possible. I don't know if I'm smart enough to make it happen. Let's see. And then we talked about the personal liability. You know, if somebody sues you, they're not going to get your home because it's not in your name. Um, but the lower cost of living allows me to take that lower salary, right? I don't need as much to live on because I'm not having to pay for all the things out of my pocket. All right, moving on. And I know that was a lot, but moving on to meals deduction. Um, don't ever, like if let's say you have a closing and you take that client out to eat after for some reason, because sometimes you do that. Um, it's not an appreciation meal. Okay. It is a recap of what you just did with that person. You're going to ask them, what did I do right? What could I have done better? That way, that meal's deductible. because you're doing it not as an appreciation, it is an educational meeting. And what did we say about anything educational is 100% deductible? Just like that cruise, you're going on there, but you're going to have a class. I mean, only reason in the past I've not tried to write off cruises, but I got that email, and a lot of you probably got it, where there was some, I don't remember if it was a board or who, but they were doing like a CE class cruise where you could sign up for this cruise and you get so many CE credits going on this cruise. And then I thought, well, heck, there it is. I'm a teacher in our school. I can teach a CE class while we're on a cruise, so I can make this tax deductible. Um, Now, if you look this over, these are some overviews of things that that are tax deductible when it comes to meals. Um, you do like when it now my CPA told me this, and I didn't know this until the last time I met with her, and we meet like quarterly to talk about tax strategy, and I meet monthly with her bookkeeper. So we are communicating quite a bit. And it came up in our last meeting that she said with meals, I've been keeping all the receipts, but she said, like gas, if it's under 75, you don't have to. She said, you don't have to keep the receipt. I did not know that. And I've been keeping them. And when I say keeping them, I scan them and it goes to her platform where we keep everything. Then I just wad them up and throw them away, but I get a digital copy of it. But you get to write off 50% on the meals. And I know someone just reminded me I've been going for an hour, so I've got to keep moving. But just know, like I said, if you need to go, feel free to go. And then you could also, if you want to go back and watch the recording, you can do so. Um, so back in 2021 and 2022, it was 100% deductible meals. That was not good for my health. We ate out every meal because it was 100% deductible. Why not, right? We got so used to we'd pick up the food and bring it home to eat it. But as you know, there's a lot of salt and stuff in the food you eat in restaurants. That's why it tastes so good, and sugar. Um, but anyway, so currently it's a 50% deduction for your meals. Now, when you do keep the receipt and you're tracking this, now the odds are you're never going to need these, but if you were ever audited, you would. But the name of the restaurant should be on the receipt, the date, and the amount. Now, those three things are usually always on receipts. Um, and there's different ways you can get them. For instance, yesterday we went to Chili's and I had the receipt just emailed to me. So what I'll do is just download it from my email and upload it to their portal. But you would want to write who you met with and what you discussed as your documentation. Um, and then take a picture of the receipt and upload it, to your cloud folder or whatever. That way you're not keeping up with paper. I know for years I kept a box and I put all these receipts in it, and then I would sit for hours at the end of the year going through receipts. And it's just so much cleaner and easier to take pictures of them or scan them and load them to a file somewhere digitally. Presentations. They're 100% deductible. So like when you do an open house, anything you buy for that open house, 100% deductible. So I'm always thinking, we raised 4 kids. So if I'm going to buy food for an event and it's 100% deductible, I'm going to make sure I buy enough that some of it's going home because my family's going to eat supper that night and it's going to be 100% deductible because at open houses, they're not going to eat everything, right? But everything you order and you take to that open house is 100% deductible. If you go like to a school event or something, or you sponsor a table and you get to go, well, whatever the cost of the table is, that's a marketing expense. It's 100% deductible. I know some of you folks teach classes. Anything you have to do to prepare for that class would be tax deductible. Um, Deductible board meetings. Did you know you could rent your home for 14 days or less each year and write that off? Like you could pay yourself from your business for renting your home to yourself. Now, this is not your home office. This is like, let's say you were doing, it'd be like client appreciation, but you wouldn't call it client appreciation. But like if you had a yearly thing at your house where everyone you had sold a home to that year or sold a home for, you invited them, but they come, you rent out your home to have this event, and everything you pay for that you use at that event. Now, you wouldn't have to pay for all the food, because if you're doing events like that, if you use the same attorney all the time or a certain lender, I'm sure they'll jump in and help, and they'll come and mingle with your clients too. But you can you can have that meeting. But what I would suggest, it's not just appreciation, but maybe have just a short survey that you have them fill out while they're there. Well, there's your documentation that you were looking at what you could do better, and what you're already doing well. You're getting feedback. It becomes an educational event. One thing you have to do, though, is it's limited to the fair market value. And you think, well, how do I know what the fair market value is to rent my house for an event? Well, I did this for myself. I looked at it before we sold the house to our company. Now I don't worry about it. But before I was thinking, well, what if we have a thing for our agents and we have the sales meeting at our house where we're going over educational stuff, but it's actually a cookout in the summer. They can bring their kids, they can swim, that kind of stuff. Well, how would I know what a fair market value is for that? Well, I went on and Googled, event places, near me. You just go in and put that, and then it would pull up places that, are within reasonable drive of your home. What would it cost me to rent that venue to go there and have this same event? Well, whatever it would cost me to go there and do it, I can rent my house for doing the same thing. Um, it may be something you break up that once a month you have meetings there with your team or something. Your team may be you and your spouse, and you document your monthly minutes, what y'all talked about. Have a rental agreement for that meeting, and then physically write a check or transfer the money to yourself. You create a paper trail for this. Hiring your kids. Now, these two kids are grown now, but this was when they were in high school, the two in the middle. You can pay them, and this year it got bumped up. You can pay them like $15,000 a year in W-2 wages, and you don't have to pay any federal tax, because they got to make over that before they pay federal tax. So then you can end up saving like $5,500 per child in taxes. And then but they have to do something. You can't just say you're paying them. I mean, you've got to be able to show that they do something. Thankfully, they do work for us. All right. I told my accountant about this in our last meeting. Our daughter that's at the University of Alabama, she works for us. We currently pay her 9 hours a week for working for us. She also makes a salary of $1,635 a month for working for us as well. And that's because it don't pay for her sorority. I make her pay that herself, but she lives in a sorority house, so it does pay for her room and board out of that. Last year, I paid her room and board, and there's this thing when a student, when you have a child in college, there's a $2,500 tax credit out there. But I didn't realize you can make too much to be eligible to receive the $2,500. So that's why this year I'm paying her a salary. It's still going to keep her down around that 15,000 mark. And if she has to pay some tax, I'll probably pay that for her. It's not a big deal, but I can at least write off that. So next year she's going to be in an apartment. And I have let our accountant know that in 2026, we're going to have a satellite office in Tuscaloosa, Alabama, that we will be renting. And that's where our daughter will work from. And it's going to save me, or I'm going to be able to write off that $12,600 in rent that I'm going to pay, because you got to rent all 12 months, even though they're not going to be there the whole 12 months. But I'm paying it anyway. Why not be able to write off that $12,600 off my taxes? And they said, okay. Um, so you got to be creative. I mean, but be legal. Be creative, but keep it legal and be able to document. Traps to avoid. Well, you don't have to issue 1099s. I know we have to make sure that we get you guys your 1099s before January 31st. But you want to file and pay your taxes on time because I don't do extensions and stuff, but people that do, I'm assuming there's probably like some fee or something when you extend. Um, I've always told my CPAs I want them done either by the date or well before the date because the information don't change. Whatever money we made last year, it ain't gonna change if you extend it months later. Everything's in order. Let's get them done on time. Um, and avoid round numbers. I mean, put in the actual number of things. Don't think, well, I'm going to round up or round down. Just put what the numbers are when you fill out your paperwork. Um, let's see. And this another one. Don't ignore or avoid an IRS notice. I I've gotten a few, and one of them was an issue this past year with there's a way that IRS changed the way that you report your, and Ming may have to help me, was it unemployment tax or something? And there used to be a way that it was submitted, and now they want it only electronically. And ours had been submitted, but I got a notice from the IRS saying it hadn't been. But we had the receipt showing it had. But if you get something, look into it. Don't just ignore it because you're not going to win a battle with IRS, right? I mean, you may
And
be
they
able to
will fine
negotiate.
you. And
What's
they
that?
will fine you with interest and penalties. So
Yeah.
I just address the issue. Sometimes might be just something minor. Like I have gotten notice from the brokerage side that there was some mismatch of 1099 between Nang and the tax ID. So you guys go ahead and get those resolved because if not, I have warned everybody that I will have to start taking 24% of their compensation right off the top because that is required by IRS. Otherwise, the brokerage will have to pay for that. And I can tell you, I'm not paying 24% of anyone's taxes. So,
Yeah.
so those are things that you just need to do. And when you get a notice, typically there's no issue with U.S. Postal Services when it comes to IRS notices. You
Yeah.
always get them. There would be a very rare instance that you would not get those messages. But yeah, just Neil's one of the guys I know that gets things done on time, very prompt. So very appreciative. Actually, this has enlightened me about some strategies that we probably need to implement. And for you, the real estate agent out there, I will tell you, just it sounds complicated what some of the things he was talking about, but in reality, it's not. You just have to be mindful what is it the objective you're trying to achieve. And honestly, take a couple of hours and think about what you're trying to do because that can save you thousands of dollars. And Neil just gave me some couple of tricks and tips on his slide that I am going to implement. Thank you very
Mhm.
much.
All right. Well, that's all I've got. That's not all there is, but that's all we're covering. Um,
Hey
I mean,
Neil, when you're teaching this class at CE,
I don't have it scheduled right now.
okay,
I've taught it recently to just our agents,
gotcha.
but it is something that I enjoy talking about.
Sure.
So, it will probably be on the calendar during the first quarter of the new year. I know we're going to focus on, GAR form changes first. That's more important,
Right.
at the end of the year and first of the year. Um, but yeah, I'll be on here on Mondays, and if I decide to schedule it, I would let everybody know.
And when you entertain doing a Zoom one, as well to just so for some of us because you're really far up north and while I
Yes.
don't mind
Yeah.
traveling and write it off as this
Mhm.
as a business expense, but the thing is that sometimes time is precious. So would you be open-minded to do a Zoom link when you do teach it so for some of us we can zoom in and just
Yeah.
review it because for me it's not about the CE credit, it's more about the
Mhm.
knowledge.
Oh yeah, and this it definitely is.
Yeah.
It's
So, well,
it's
thank you
worth
so
more than
much.
seed.
You got a lot of kudos out there. Um, so one of my agent asked, is CPA taking new clients? Um, and also the other one said, you mentioned portal filing receipt with CPA, but do you have an app or software you recommend filing receipt digitally? Um, and kudos.
Well, to answer some of those questions, so before I was using our CPA's their app and platform to upload my receipts to, I was using QuickBooks. We do QuickBooks Online, but the thing my CPA told me, they said that they would rather I upload them to theirs only because it further bogs down my QuickBooks Online because there's so much information in there already. So I don't understand all that, but I took their advice and I just upload it to their platform. But but if you don't, let's say you do your own taxes. When I was an agent, when I didn't have other agents under us, and it was just me, I did my own. But then when we had to start doing 1099s, the first year I did it, and then I decided as we started growing, all right, if I mess up my taxes, that's one thing. I can't mess up everyone else's. So I did hire a CPA. But if you do your own, I would just create a file on your computer where you upload them to, and that that way you can have them divided up by years um, that way. But I would make more than one copy even doing it digitally if you're throwing those receipts away because Ming knows we do paperless pipeline backups every month for our transactions. Well, I back them up to my computer and I also put them on flash drive so that I have a hard copy of it that way. Well, I say hard copy, but I get multiple downloads so that we know technology sometimes you can lose information. So I would make more than one copy of it probably.
Honestly, storing cloud, if you have a Dropbox or a Google account, storing your Google account, just name the files on like 2022 tax receipts, 2025 tax receipts, or if you want to even go further than that, do that category and then a subcategory for meals because it's only 50% write-off. If you want to do a vehicle, whatever. But honestly, you guys, I would sincerely hope that you use some type of software, keep everything in because trying to track all these manually, it's going to take you more time. And you're better off just hire a CPA, seriously, because your time is worth more than that. And what you make in one transaction will be more than pay for a CPA for the entire year. So time is money, y'all. And
I'm
what
gonna put the I will put our CPA in the chat. I'm gonna put their
yeah,
website on there. They do take more people. I know my oldest son, he moved to them because he does do very well in the business. And I know they had him, they told him, he said, you need to be an S corporation, you need to be doing this different. Um, let's see. Okay, there it is. The thing I like about them now, your bill's not going to be like mine. Mine's just over 1,000 a month, but they do a lot of accounts for us. I mean, it's well worth it, and that includes filing our taxes. There's no separate tax bill when they file our taxes. That's so I spend just over 12,000 a year, and that's a write-off. Um, that I don't have to worry about if Gret calls me and says we need to see your escrow account. Well, I know they've got it up to date and I can turn it over to them. And if there's any problems, she's an IRS certified accountant, and she's told me, we'll go all the way up to the guardrail, but I won't cross over it. But we will get every deduction we can. Um, so I do like that we meet monthly and go over our books because we have so many and there's so many things that we're able to any questions they have, I'm able to on a Zoom. Usually I know from the month before, but if you wait a year later and you say, what was this charge for or what was this check for, you better hope you recorded it somewhere because the odds of remembering a year later may not be that good. Um, let's see. And the other thing I was going to do was going to see if I could put these slides. I was going to put them in the chat too if you wanted the link to them.
And if you want, Neil, if you want to send it to me as PDF form, I'd be more than happy to share those as
Okay,
well.
I'll do that. I'll send it to you, Ming.
So anybody have any question? So one of the question was, what's the difference between write-off and business loss? Write-off is just expenses that you write off against your income. Business loss is when you actually have less income than what you're writing off. Okay. And one of the things was credit cards. Once again, like Neil mentioned earlier about the credit cards, there's certain item you don't need receipt, like utilities, that what you're paying your business utilities for. If your meal's less than $75, if your gas is less than $75, all that stuff, you do not need a receipt. But if you are doing something extraordinary, you may need a receipt, just so your accountant can justify at the end of the year. And I'll recommend you do a monthly, when you get your statement in, go in there, highlight gas, whatever it is. It shouldn't take you but just a few minutes, and submit that to your accountant. That what they do, they'll do what I consider a consolidated one-line entry once a month. Is they're recording every single little thing. And that's why they asked Neil to upload those things into their portal, because otherwise the accountant has to go to the online QuickBooks and reconcile every one transaction that comes in. Sometimes we get charged for credit cards fees that you guys pay your monthly bill to. And for them to record each and one of them, it doesn't make sense. They'll record one entry for entire months.
See. All right, I sent you that link right then, Ming.
Thank you. Okay. All right. Anybody else have any questions?
Well, thank you guys. Hopefully, if you got at least one thing out of it, it could save you money. It was worth our time, right?
Absolutely. Hey, look, I don't think we ever had anybody stay for almost an hour and a half. So great job. You definitely capture everybody's attention, and includes mine as well. So if once again, y'all, if y'all interested in his class, he'll be teaching first quarter next year. And you're more than and Neil will send me well, Neil comes to Mastermind every Monday. So he'll announce when it is and when the Zoom link can be you can copy and paste the Zoom link, Neil, for us. That'd be fabulous.
I did
All
have a
right.
question. I put a question in. Do you need an LLC for each address? And should you put your car in an LLC?
I asked them that. If you put your car in an LLC, here's what happens. A lot of insurances, your rate is tied to your credit score. If you put it in a new business, your rate's going to be higher on your insurance. So it's better because your business income flows into your personal taxes. So basically you're using your vehicle to deduct. It's a deduction on your personal taxes, even though you're using it for business, but the write-off will be in your personal. Does that make sense?
Yes, it does.
And you do want to keep as much separate. And a good thing about the state of Georgia, because I have LLCs in other states, like for instance, North Carolina, we have an LLC, $200 a year renewal, whereas in Georgia it's 50 per. So 4 of our LLCs in Georgia cost the same as just the one in North Carolina. So you guys were in a great state for doing business because the cost is less than other states. I forget what Florida, it's 100 and something a year, 130 something a year, I think, for that LLC. But it's good to have like different LLCs for different entities and different things you're doing. That way, if something happens to one, it don't affect the other.
It depends on how complicated you want to get. You can get as complicated as you want, or you can simplify it as much as you want. So if you don't want to put all your eggs in one basket, because this particular business might have a much higher liability, then you may want to create multiple LLC for that purpose.
Now, as
Thank you.
far as your like a credit card, it is good if you have business accounts under that LLC at your bank to have a credit card, because that's how that business will build credit, is with that credit card, but only do business transactions on that one. And we're very good about keeping them separate. Like when we're charging something, like if I go to Costco, we have different real estate offices. I can't tell you the last time I paid for toilet paper or paper towels for my home. We buy them for the office, and we always have enough to go home too, because we work from home. So, but when I'm in Costco, I don't put my peanut butter on the business card. I buy it with my personal, and then I run up a separate order while I'm standing there in line, 2 separate orders for all the coffee, paper towels, toilet paper, anything I think I could justify as a business expense, it goes on the business card. But if I'm ever audited, I'll say, no, the same day I got all this business stuff, here's my personal card. And I bought these personal items with it. So it's all about documentation. That's the key. All right.
All right, and I sent y'all all the text link on the presentation. So y'all should have it, if you would mind, copy that link so you have it for your record. All right, well, thank you so much, and thank you,
All
Neil,
right.
for your time. I know everybody's time is valuable. Definitely got a lot of enlightenment out of this, and we appreciate you, and we'll look forward to seeing you guys next week in our next episode of Mastermind. And y'all, please invite other people, seriously, that you want to help, because this is what we do as a group to create more synergy and kind of glean from each other, okay?
Quick
Awesome.
question.
Uh-huh.
These masterminds are only for Max One agent, correct?
Not necessary. So we have had a lot of agents. Well, we have had requests, and some people sometimes peep in. I do know most of the masterminds are all our agents,
Okay.
meaning Greater Atlanta, the affiliates, Neil up there, communities, the platinums, the partners, the executives, and the sorry, Neil, I'm having a
Premier and
singing
Catalyst.
Premier and
Yeah.
Catalyst. So most of us are, and if you got someone in Maxim One that you know you can help, or is struggling or what have you, to me this is a no-brainer. It's such a good program. So
Mhm.
invite them.
Okay. Thank you guys for sharing.
All right.
Absolutely. All right. Well, thank you, Neil, for your time.
All
I
right. See
appreciate
you
you.
guys
Y'all have a
Monday.
great Monday.
All right. Bye.